Investing in bonds is an essential step for diversifying your investment portfolio and generating steady income. This guide breaks down the basics of bond investing, types of bonds, their benefits, and the risks involved. 1. What are bonds? Bonds are debt instruments issued by governments, corporations, or municipalities to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of the bond's face value at maturity. 2. Types of bonds. Here are the common types of bonds. 1. Government bonds, issued by national governments, for example, U.S. Treasury bonds. Low risk, ideal for conservative investors. 2. Corporate bonds, issued by companies to fund business operations. Offer higher returns but come with higher risk. 3. Municipal bonds, issued by local governments or municipalities. Often tax-free and suitable for long-term investors. 4. High-yield bonds, junk bonds, issued by entities with lower credit ratings. High return potential but also high risk. 5. Savings bonds, offered by governments to individuals for long-term savings. 3. Benefits of investing in bonds: steady income, regular interest payments, also known as coupon payments. Diversification balances risk in a stock-heavy portfolio. Capital preservation, less volatile than stocks, making them ideal for risk-averse investors. Tax advantages: some bonds, like municipal bonds, offer tax-free income. 4. Risks of bond investing. 1. Interest rate risk: bond prices fall when interest rates rise. 2. Credit risk: issuers may default on payments if they face financial trouble. 3. Inflation risk: returns may be lower than inflation, reducing purchasing power. 4. Liquidity risk: difficulty in selling bonds before maturity at a fair price. 5. Steps to start investing in bonds. 1. Understand your goals. Determine why you want to invest: steady income, capital preservation, or diversification. 2. Research bond types. Choose the bond that suits your financial objectives and risk tolerance. 3. Open a brokerage account. Most bonds can be purchased through brokers or online platforms. 4. Evaluate credit ratings. Look for bonds rated by agencies like Moody's, S&P, or Fitch. Higher-rated bonds have lower risk. 5. Diversify. Spread your investment across various bonds to minimize risk. 6. Monitor and adjust. Periodically review your portfolio to adapt to market changes. 6. Where to buy bonds. Brokerage platforms, most popular for bond trading. Treasury websites, for direct purchase of government bonds. Mutual funds and ETFs, for exposure to a diversified pool of bonds. Bond investing offers a reliable way to build wealth and protect your portfolio against market volatility. However, understanding the risks and aligning investments with your financial goals is critical. With this beginner-friendly guide, you're well equipped to step into the world of bonds confidently.